Well, good morning, good afternoon, everyone. We are going to begin the webinar in approximately 1 minute. Welcome, everyone, to our Ask the Experts webinar today. We appreciate each of you joining, and we're grateful to be able to spend the next hour with you. My name is Bill Maloney. I'm an Executive Managing Director with Riveron. We're looking forward to engaging with you today during this discussion on the 2021 audit cycle and a number of hot topics there. We referred to last year's audit cycle as one that was unlike any other, with a host of accounting and reporting issues that were brought to the forefront by the pandemic, resulting in shifts to remote work, shuttered businesses, and then a standstill in deal activity. While some industries are recovering, albeit slowly in many cases, and many organizations continue to operate remotely, we now have robust capital markets that have contributed to a very hot job market for accounting and finance professionals. This turn of events has spurred a unique set of challenges. And companies now will be facing a number of key pressure points this year, not the least of which is the risk that has come to the forefront with what has been dubbed the Great Resignation, and so many companies experiencing unprecedented levels of turnover. That risk that exists now for accounting and finance departments when a key person resigns or leaves abruptly is critical to prepare for, and we will discuss that some today. So I'm joined by 5 of my colleagues who are expert in the areas we're going to discuss. Jeff Kranzel is a managing director in our New York office and one of our experts in the deal space. Ann Heffington is a managing director in Dallas and an expert in all things tax. Matt Ray is a director in New York and one of our internal control experts. Jason Loy is a director in Chicago, and he's one of our impairment and valuation experts. And then Val Flanagan is a manager in our DC office and an expert with business combinations and leases. So really looking forward to hearing from each of these experts and their experiences as they highlight some of the ways to address the hurdles we expect companies to face in the coming months. Before we jump into the content today, just a few key reminders for everyone. On our website, riveron.com, you can access all of our previous Ask the Experts webinars. There's a number of key insights there on accounting, reporting, and operational topics. And then during the webinar today, we will include 4 polling questions, which must be answered to be eligible for CPE. Please make sure to enable your pop-ups. If they're disabled, you won't see the questions come up. And also, with that said, we welcome your questions. There is a Q&A option in Zoom that many of you are probably familiar with. Feel free to use that. We'd love to see your questions come across, and we'll try to get to all the questions. If we don't, we'll respond separately to you. The webinar evaluation form and the CPE certificate will be emailed to you within 2 weeks following the webinar, along with access to the deck today and our contact information. One thing to note, the on-demand video will be available on our website, but that on-demand is not eligible for CPE. So with all of that, let's jump right in, and we'll start with a polling question. Polling question number 1. That question is your company anticipating any of the following transactions in the next year? A, an acquisition, B, a divestiture, C, going public, or D, no anticipated deals? Again, make sure your pop-ups are enabled. We'll give you 30, 45 seconds to log and answer that. And while we wait for that, Jeff, let's jump right into it with a question for you, which is, we hear a lot of discussion about how much easier it is for companies to go public via SPAC. You know, first, maybe you can confirm or deny whether that's actually the case, but also, what are some of the messier situations that you've seen recently with your clients?
Sure, Bill. Yes, there are definitely a lot of ways that going public via SPAC will be easier than a traditional IPO, and we'll get into that in the next couple slides. but it doesn't necessarily mean that all SPAC deals are going to be easy. For example, people think that one SPAC can only acquire one business, and that's not always the case. I've got a really interesting deal on the go right now. It's actually a de-SPAC business combination where multiple entities in the same industry, but different geographies are being combined. So, it's creating a host of logistical issues, coordinating financial information from 3 different operating companies with different auditors, and also introduces some interesting accounting issues, such as which entity is going to be the accounting acquirer in the deal. So, it's definitely some tricky situations that are going on out there. Okay, and it looks like we've just got the results of the polling question. It looks like 41% of the group today are considering an acquisition, and about a third have no deals anticipated. So still a good number of about a quarter of the group are either going to divest of something or go public themselves. So it seems as though a lot of what we're going to be discussing on these next couple slides on deal activity are going to be relevant to everybody still. So maybe with that, we'll start talking about deal activity. The highlight this year is there really has been a rebound in the number of deals that we're seeing. As recently as August of this year to date, according to a DFIN publication, we've seen 314 non-SPAC IPOs, 419 SPAC IPOs, and 121 completed de-SPACs. The good news is there's still 440 plus SPACs that are searching for a business combination with 118 billion in trust. So there is still a lot of cash out there to take private companies public. We've been throwing the word SPAC around, and I'm sure many of you here on the webcast today are familiar with the SPAC. But maybe before we talk about some of those detailed considerations, let's just review in a couple seconds exactly what a SPAC is for anybody on who's not familiar. A SPAC is a blank check company. It's actually a company that's listed on the stock exchange, and its sole purpose is to raise capital and identify a target company to acquire. As a public company, when a SPAC identifies a private company it wants to take public, it takes that company public without a traditional IPO process. So makes it easier, Bill, like we said earlier on, because it avoids the involvement of underwriters in the going public process. You won't need to do road shows and pitching, because the way that the deal closes and it shows that the shareholders are interested is a shareholder vote of the SPAC to actually close the business combination, which takes that company public. Even though it is easier, there's still a number of challenges in the SPAC process. In a traditional IPO, what we've seen historically is companies have undertaken IPO readiness assessments. So they're looking at gaps in reporting, controls, processes, things that the company needs to do to become public company ready. But because of how hot the deal market has been recently, we're actually seeing this happen in reverse. Companies are going public and then looking at system process, people changes that need to be made in order to comply with those public company requirements and timelines. So what are the key areas that you should be considering when you're thinking about going public? The first is upgrading accounting and disclosure. So there are specific SEC accounting and disclosure requirements that private companies will often have to change as part of their going public process. For example, some private companies take advantage of goodwill amortization, or they'll need to be enhanced disclosures. So time will be spent preparing those detailed disclosures. Audit procedures. Even though you've had an auditor for a number of years that can help you in the audit process, the auditing standards that are required for a public company, called PCAOB auditing standards, require a higher level of audit work than the AICPA audit standards that auditors often follow for their private companies. So even though they've signed off audit opinions in past periods, they'll often have to go back and top up those procedures with additional testing. In addition, as part of that process, they may need to look at quarters, which weren't done before. And companies themselves may not have had strong cutoff procedures at quarters. So we see a lot of companies spending time quarterizing and just really kicking the tires around quarter end cutoffs to make sure they have their transactions booked in the right period. The next thing we see companies spending a lot of time on as part of this process is accounting standards. Like everybody here knows, private companies often have an extended period of time to implement accounting standards. For example, ASC 842 is effective for public companies, but not yet effective for private companies. Same with CECL. As part of the going public process, you'll have to bring all of those forward. So you're essentially going to be implementing a host of accounting standards for the first time as part of this process. We're also seeing a lot of cross-border activity, and that brings with it a lot of its own considerations. For example, US companies that wish to access foreign capital markets, or foreign companies that want to access the US capital markets, are having to undertake US GAAP to IFRS conversions or the other direction. And don't underestimate the amount of time that it takes to complete this exercise. While certain areas are converged, such as revenue recognition, there's a lot of areas that are quite different, maybe in the financial instrument space, that cause companies to spend a significant amount of time. In addition, cross-border deals may require even a change in auditors. I've got a deal going on right now where a large African manufacturing client of mine wants to go public in the US via SPAC. And it has a global accounting firm as its auditor, but that auditor is not a PCAOB registrant. So as part of this process, in addition to a conversion, they actually have to have a new accounting firm who's a PCAOB auditor re-auditing those prior periods. Lastly is internal controls. Although many companies have relief in the first year, it's really important for a company to start planning for its SOX compliance timeline. There's going to be a host of other things that are going to require attention and time from the company after going public. So it's really important to make sure that there's a solid plan in place to become SOX compliant when required.
So Jeff, on that last point there around internal controls, in addition to planning for mandatory compliance with SOX, where else are we seeing companies investing time post-IPO?
Yeah, Bill, I think where we're seeing a lot of companies invest that time is really in the technology and the process space. For a lot of companies, the systems that they've been using as private companies and the close procedures maybe aren't as efficient as they need to be to meet those timelines. So we're seeing companies upgrade pretty soon after going public to make sure that they can comply with the quarterly reporting.
Got it. Very good. Thanks, Jeff. And thinking about internal controls and the additional opportunities to invest there in different solutions and improve the accounting and finance department generally brings us to a discussion really on this key person risk that we kind of alluded to at the front, and then in remote audit environments. So Matt, let's bring you in and let's go there next.
Yeah, thanks, Bill. As Bill alluded to during the opening, with the start of the economic recovery earlier this year, we quickly saw the development of what's easily described as an unusually hot job market. And companies of all shapes and sizes are experiencing higher levels of attrition, and it makes it difficult to fill open positions. And this can give rise to significant key person risk, as it's not uncommon for individuals within the accounting and reporting teams to have significant institutional knowledge and intimate, detailed process and transaction knowledge. And that isn't easily transferred to others during a 2-week notice period. And the risk is further aggravated by the evolving COVID pandemic, which can result in key staff being taken out of play without warning. But as with many challenges, there are opportunities to prepare and to plan, all of which can help teams successfully navigate the current staffing environment. One of the key steps we see to help mitigate this risk is to create desktop procedures. This helps to memorialize key steps in a process, and is something many companies have had on a wish list for a while, but maybe haven't quite gotten to yet. And while it can be time consuming, you can break it down into its component parts and start with the more complex processes, those that would be harder for someone new to pick up quickly. And there's a very similar benefit to formalizing documentation around accounting policies. Sometimes these are understood, consistently applied, and have been discussed with the audit team, but undocumented, the nuance around some key management judgments might get lost in transition. Another area to consider is whether key documents, especially contracts, agreements, and other sensitive files, are stored on local hard drives, which can make it very difficult, if not impossible to recover after a person leaves. It's important to establish a secure repository to maintain key documents and to make sure appropriate personnel have access, including passwords to protected files. Files saved to a local hard drive might relate to issues or transactions from months or even years ago, and can easily be forgotten about during the transition process from one person to another. So taking the time to be thoughtful about record management can avoid costly efforts to recreate or recover lost documentation. And I know it seems intuitive, but I had a recent client example where the CFO's departure was very sudden, and there were certain files that were password protected on the CFO's laptop. And still, months later, the company is working to reconstruct support that couldn't be recovered. So something worth thinking about. Another strategy to consider is how you might cross-train employees. If a team member is suddenly unavailable during the middle of year-end close, who has the knowledge to step in and help cover their responsibilities? Hopefully there's someone with the experience to step in, but if not, consider investing the time to cross-train staff, making sure each key team member has an understudy of sorts with the knowledge to step in on short notice. And a final thought as we think about how to effectively deal with employee turnover and the impact on reshuffled roles and responsibilities is to be mindful of the control environment, and in particular segregation of duties. Sudden changes in responsibilities can definitely have adverse effects on the control environment. And with that, Bill, why don't I kick it over to you for our next polling question?
Excellent. Yes, and a polling question on this exact topic. So polling question number 2, has your team experienced unanticipated turnover or hiring challenges in the past year? A, turnover challenges, B, hiring difficulties, C, both, or D, neither. Again, go ahead and log your answers there. We'll give you 30, 45 seconds on that. And while we wait, Matt, kind of sticking to this topic, there's little doubt that turnover we've seen has impacted all of us. What do you see in terms of direct impact to the audit cycle and to audit teams this year?
Bill, I think there's probably little doubt that a lot of companies who've had turnover will feel the impact during the audit, especially turnover within the accounting team that happens close to or during year end can be very disruptive. But companies aren't the only ones feeling the pain. Audit firms have been very busy with capital markets activity, and Jeff was discussing earlier, but they've also experienced elevated turnover. And while changes to the audit team aren't uncommon, they can definitely be pain points during the audit. It looks like most of us have had, both hiring difficulties and turnover challenges. And there's a select 18% of us that are very lucky. So with that, why don't we jump into the next topic, and that is the year-end audit. And when it comes to the year-end audit, planning and preparation is always critical, especially this year. Given all that finance and accounting teams are dealing with, whether it's capital markets transactions, turnover, or any variety of other pressing issues, it's more important than ever to be thoughtful and deliberate about preparing for this year's audit cycle. For most of us, these aren't new topics, but hopefully this can serve as a helpful reminder as we start preparing for the 2021 year-end audit. One of the areas I always think about first is what can be done during interim. And it never fails that despite our best intentions, we end up working through challenging audit issues late in the process for transactions that occurred well in advance of year end. So as you engage with the audit team around planning and coordination, think about what incremental work can be done during interim as a means of decompressing year end. Significant transactions occurring during the year, such as debt modification, share-based payment awards, non-recurring transactions, and even revenue. These are all great candidates for interim procedures. But aside from interim, now is also a good time to prepare for year end. So get the audit team's request list early and agree on realistic deliverable dates. Make sure key accounting memos are prepared early to allow time for adequate review. Consider opportunities to get specialists involved early in the process, both specialists used by management and specialists supporting the audit team, as this can be a frequent pain point for both management and audit teams. And lastly, communication is really key. Have an agreed upon plan for the nature and frequency of status meetings throughout interim and year-end field work. It'll go a long way to monitoring progress and making sure issues are addressed timely. And next, I wanted to dive a little deeper into the topic of internal controls. And as Jeff Jeff was discussing earlier, we've seen a major uptick in the number of companies pursuing a path of becoming public, either through a traditional IPO process or through a transaction with a SPAC. And while there can be some temporary relief on SOX compliance, either by qualifying as an emerging growth company or related to a significant acquisition during the year, take advantage of whatever runway is available to prepare for SOX compliance so you can hit the ground running as a public company. Over the years, I've seen a number of clients that have pursued a quick IPO strategy in an effort to take advantage of an advantageous market opportunity. And SOX readiness ended up as an afterthought. But that lack of preparation for SOX compliance often led to significant deficiencies and material weaknesses, but also just basic errors in public filings. So if your company is considering becoming public, it's important to start planning as soon as possible, as the effort to stand up a robust SOX compliant internal controls program takes some time to accomplish. It's also worth considering whether your team has the bandwidth and experience to lead the effort internally, or whether you'll need additional support from advisors. And when we work with clients on SOX readiness, we generally think about organizing the effort into 5 phases. The first is the risk assessment and scoping phase, which methodically considers quantitative materiality and then qualitative risk factors such as inherent risk, fraud risk, complexity of the account and underlying transactions, subjectivity and degree of judgment, among others. And this process is used to determine which accounts, locations, and processes will be in scope for the SOX program. The second phase is the design phase, which really focuses on understanding the current state through detailed process walkthroughs, preparation of the risk and control matrices and flow charts, ensuring controls are appropriately designed, and identifying any control gaps that need remediation. The third phase is remediation, which can really vary quite a bit based on the nature and volume of gaps identified during the design phase, but it's an important part of ensuring those gaps are addressed. The fourth is controls testing, which involves the development of detailed testing plans and then testing the controls using appropriate sample sizes to conclude on the operating effectiveness of those controls over time. Any deficiencies that are identified in testing have to be remediated as well. And then the fifth phase is reporting. And that really leverages the results of the internal controls testing, an assessment of any identified and unremediated deficiencies in support of management's report on the effectiveness of internal controls over financial reporting that will be included in the first Form 10-K where compliance with Section 404A of Sarbanes-Oxley is required. Because SOX readiness can be a lot of work. And as you plan, it's important to understand the timeline associated with becoming public, the impact of any available relief, and the first filing, which will require SOX compliance. So this is at a very high level. It's an overview really to kind of illustrate the effort associated with SOX compliance and hopefully provides a framework as you think about a SOX readiness path.
Matt, as we think back to the 2020 audit cycle, obviously many folks were experiencing audits in a remote environment for the first time. Likely much of that may continue here, but so anything to be thinking about with respect to remote audits this year?
Well, there's no doubt that at this time last year, a lot of folks were pretty nervous about remote audits and how they might play out. But I think at this point, the general consensus really seems to be that they went much better than many of us expected. That doesn't mean they were perfect by any means. So companies really should think about what didn't go well last year and adjust a strategy this year.
Yeah, no, that's great. Yeah, definitely the feedback I think we received was that much better than expected, which was nice to see. So, all right, well, thanks, Matt. And one thing that never seems to change is complexity around accounting for income taxes. Always seems like there's just continuous movement in tax law to be aware of. So let's talk taxes for a little bit. Ann?
Let's do. Good afternoon. Let's talk about, as Matt and Jeff pointed out, the what we need to be thinking about as we get ready for year end. So let's first talk about what has stayed the same. 18 months ago, almost to the day, the CARES Act came into play. It had a lot of taxpayer-friendly provisions that have mostly expired. So when you're getting ready for year end, you need to consider those. So I've outlined those here in the slides. One thing that is staying the same, which is great news for today, is the federal rate is still 21%. You may be hearing noise in DC around the Build Back Better Act that is proposing raising the tax rates up to 26.5%, but the likelihood of them getting that through, in my mind, is very slim. So for now, it's 21%. If you had changed your rate on your deferred tax asset schedules, you need to look at that. Another thing that was corrected with the CARES Act was qualified improvement property and the eligibility of that property for bonus depreciation. Qualified improvement property, we tax nerds call it QIP, is improvements made to the interior portion of a non-residential building. So this is something that retail companies do quite a bit of, refreshing displays, the layout of stores and such. So that is still in play. And then the Employee Retention Tax Credit, or ERTC, that was enacted with the CARES Act to incentivize employers to keep employees on the payroll while suffering from economic hardships of COVID. Since we're still in the pandemic, I can't believe it, 18 months later, we're still working remote, we're still wearing masks, and some businesses aren't fully operational. So this Employee Retention Tax Credit has been extended through the end of this year. All right, what has changed? These are very important to take note of as you go into your in provision time. So net operating losses, or NOLs, under the CARES Act enabled taxpayers to carry back their losses 5 years. And those years that's eligible are the 2019 year and the 2020 tax years. That 5-year look-back period goes back to the 35% rate. So there are a lot of benefits to be gained in doing that NOL carryback. But we're back to the regular rules. So the next bullet here talks about the NOL limitation now reverts back to the pre-CARES Act. So if you have taxable income, you're only allowed to offset it by 80% with your net operating loss carry forward. So let's do a simple example. Say you have $100 taxable income, you have $200 of NOL carry forwards, you don't have any income to carry it back and offset like the first bullet addressed. So you had the $100 of taxable income, 200 of NOL, but you can only offset 80% or take 80 of NOL. So you have taxable income of 20. So that is the rule now for the 2021 rules to be conscious of when doing your estimated tax payments. The other item under the CARES Act was the change to the interest expense limitation. A lot of our private equity companies benefited from the increased limit on interest expense deductions. It is 50% on EBITDA, so earnings before interest, taxes, depreciation, amortization. Now, that was the CARES Act. In 2021, this returns to the 30% calculation. So your interest expense allowed is going down. I know it seems wonky, 50% to 30%, but you're limited to 30% of that EBITDA number. So what to be looking out for? So this interest expense limitation that has been on the EBITDA in 2022 changes to EBIT. So you no longer get to add back depreciation and amortization to calculate your deductible interest. Could generate more interest expense carryovers, deferred tax assets. So you'll be on the lookout for that next year. The payroll tax deferral, this was another item that the CARES Act brought in to help employers. The 6.2% tax that the employer pays related to Social Security tax was deferred, and all those taxes in 2020 could be deferred until 50% is due December of this year and 50% December 31st of 2022. So don't miss those deadlines. There is no interest, no penalties if you pay them by those deadlines. There's also a planning tip around this. So if you haven't, so fiscal year taxpayers who haven't filed their 2020 returns, say you're a January 31st taxpayer, if you pay those payroll taxes within 8.5 months, so by October 15th, you can deduct them in your 2020 return. It's a big benefit because those 2020 NOLs we talked about earlier can go back 5 years to the 35% rate, so you can get more cash refunded with your NOL carryback. All right, I think it's time for the next polling question, Bill.
Indeed it is. All right, thanks, Ann. So polling question 3, everyone. Which tax legislation change has had or do you anticipate having the biggest impact on your company? A, NOL loss limitation, B, interest expense limitation, C, payroll tax deferral, or D, a potential tax rate change. While we give just a minute here for everyone to log their answers, and looking at this question here, how are you seeing clients take advantage of these things, specifically the payroll tax deferral?
Well, the companies that are aware of this can get a big benefit. I was talking with a client earlier this week, and with the chaos of trying to get compliance out the door and getting ready for Q3 close, they kind of lost sight of this benefit of prepaying their payroll taxes that have been deferred. And they're going to get over a $2 million permanent benefit just because the tax rate is 35% where they're going to deduct it versus 21%. So it can be a really big benefit to companies, to look out for that. All right, that is not a surprising answer. So yes, NOL loss limitation was 2, but a potential tax rate change would impact most all of you on the phone. All right, thank you.
Yeah, that's great. Not surprising at all. You're right. Thanks, Ann. Jeff, let's shift gears here a little bit, and we'll get into the guts here of some of the complex accounting matters that we expect to see this audit cycle, starting with debt modifications and then debt versus equity.
Sure, Bill. So for those of you who joined last year, this slide might look very familiar. You'll recall, what we were saying was that debt modifications were discussed as an FY 2020 audit issue, mainly because companies were looking at ways to make their debt loads more manageable in light of business closures. So, while certain industries are still struggling, I'm happy that this year we can talk about debt modifications again, but for a slightly different reason. Over the course of FY 2021, a lot of companies were really able to take advantage of the declining rate environment and refinance their existing debt. So not trying to keep the business going, but rather take advantage of the lower rates, which is great. So quick refresher on debt modification accounting. The first step when looking at any debt modifications is to assess whether the modification is what the accounting guidance calls a troubled debt restructuring, TDR. So a TDR has 2 items that must be met. The first is that the debtor must be experiencing financial difficulty. And the second is the lender must have granted a concession. So that's the key gating question. If you are in the TDR guidance and assets are transferred or equity is issued to settle the debt, you recognize a gain for the excess of the carrying value, the excess of the carrying value over the fair value of the assets or the equity interests. If the terms are modified, you account for this prospectively. However, if the undiscounted future cash flows of the new terms are less than the carrying amount, you recognize a gain. So if it is not a TDR, which I hope for people who are looking at it this year, it's not, you apply what's called the 10% test. So the purpose of the 10% test is to determine if a debt modification represents an extinguishment, that is settling of an old debt and recognition of a new debt, or it is a modification. So you apply extinguishment accounting when the present value of the future cash payments is at least 10% different than those of the original debt. If that's the case, take down the old debt, bring on the new debt, and you recognize the difference in P&L. Otherwise, you account for the modification prospectively. So that's a key aspect of that 10% test, which is strictly quantitative. Remember that if you have any debt modifications, TDRs or otherwise, just to keep in mind that there's some enhanced disclosures that are going to be required, the accounting treatment for that debt, the terms of the debt, and any gains or losses that were recognized as a result. Another accounting area that we're seeing a lot of this year is debt versus equity classification. Like many of you on the phone will be painfully aware, due to multiple rounds of capital raises, whether it's multiple classes of shares, preferred shares, convertible notes, warrants, whatever, cap tables are extremely complex. And as companies go through an IPO process, whether SPAC or traditional, the accounting classification, that is debt versus equity for each of these instruments, comes to light. My personal view is, I think this is one of the most complex areas of US GAAP. It's very rules-based, depending on the type of instrument. And while I'm really happy that the FASB is undertaking a project to try to simplify that, for now, that's the guidance that we're in. So make sure that you're really dedicating the time that it takes or involving external advisors to help you navigate this process because it's very difficult. So for example, certain mandatorily redeemable instruments are going to have to get looked at for the first time as part of the IPO process. This will often involve third-party valuations. Companies might find that there are bifurcated embedded derivatives, like an equity conversion feature in a convertible note, for example, that they'll have to separately account for and value. That's going to involve time with specialists, and the audit team is going to have to involve their specialists. So make sure you're planning for that. Another item that companies are thinking about for the first time in the debt equity space is presentation of equity. So if for public companies, when you have an equity classified instrument, you need to consider if it should be presented in permanent equity or what's called mezzanine presentation that sits between liabilities and permanent equity. And that applies to certain redeemable equity classified instruments. And working through this yourself and with your auditors and your valuation advisors is all really important, because this is an area that the SEC frequently scrutinizes. Companies often will receive comment letters on the debt versus equity classification for certain instruments, as well as the valuation. So while it might seem like a lot of time is spent on this, it really is something that we want companies to really know is important. So with that, I think I'm going to hand it over to Jason to talk a little bit more about some valuation issues.
Yeah, today I think we'll talk through the valuation issues for year-end through the context of a life cycle of the transaction. So first, we'll start with purchase accounting under ASC 805. Then we'll discuss annual impairment updates, and then talk about any other considerations for the year-end audit. So under ASC 805, if you've made an acquisition or you have a pending acquisition, you'll need to have an estimate of the opening balance sheet and fair value inputs for your year-end reporting. So depending on the standard determines the level of complexity and effort that's required. So public companies will need to assess all the assets and liabilities of the target acquired. It sounds like an undertaking, but in reality, a lot of the net working capital items, AR, AP, cash, obviously would come over at book value. For tangible assets like machinery, equipment, furnitures and fixtures, buildings, land, it's really assessment of the materiality of those assets relative to the transaction and the overall acquiring company. So if you're a software company and you have very little in terms of hard assets, you could probably make the assessment that book value approximates fair value. If you're a manufacturing entity and their material assets, depending on how old they are, if they're old assets that have been fully depreciated, but they're still has a useful life to them, it's likely you'll need to perform procedures and fair value analysis around those assets. And then lastly would be intangible assets. So looking to see what identifiable intangible assets exist in the target. Things like developed technology, customer relationships, trade names would all need to be assessed and marked to fair value. Keep in mind that these are often items that are not already on the balance sheet, as they're typically self-generated unless there is an acquisition made by the target previously. For private companies, they are able to elect the private company standard that allows them to subsume customer relationships and non-compete agreements into goodwill. If those assets are not able to be separated from the other assets of the business, then you're able to separate those assets, subsume them into goodwill. We're often asked, if there's a preference from private companies, whether to adopt the private company council or the public company standards. And it's really a matter of preference. As Jeff was talking earlier, if you're a private company and you make this election, and you decided to go public at some point in time, you would have to go back and restate your analysis to essentially put it back to the public company and pull out the non-compete agreements and customer relationships from any prior transactions. Some companies like to have this in their back pocket, so they might want to have this done at the time they're making the acquisition. Some companies just want the path of least resistance and don't have any plans to go public, so just want to move forward and go down the easier path. Next, I'll bring up 2 points that typically get overlooked in an acquisition: rollover equity and earnouts. So rollover equity is when the selling shareholders essentially give a class of equity to the sellers as part of the total consideration, essentially giving them skin in the game as the business moves forward. These analyses can be fairly complex. For public companies, it's as simple as publicly traded share price times the quantity given. For private companies, you would need to fair value the equity of the company as a total, and then drill down to determine the fair value of the actual class being given. So as Jeff talked earlier, the complex capital structures with different classes of preferred and common equity, different rights and preferences to each one of those, makes these share evaluations somewhat complex. So something you need to take into consideration. Next, on earnouts, these are used to bridge the gap between the buyers and the sellers analysis. So it's an acquiring company giving a set purchase price up front, and then consideration based on certain milestones or targets that have been agreed to between the two parties. There's no uniform structure here, so these can be based on new products coming to market, increasing market share. They could be revenue targets or EBITDA targets, multiple years. It really depends. So a lot of companies think that they assume that they'll have to make these payments, so they'll book the total amount as their fair value estimate, but you really need to run procedures depending on the structure of the earnout to understand what that fair value is. And that could mean using option pricing methodologies or as complex as Monte Carlo simulations. Next, we'll talk through impairment assessment. So public companies and private companies have a little different path and result getting to the same place. So public companies are performing this test annually, typically in the fourth quarter from what we see. Private companies are testing when a triggering event occurs. Triggering events can be increased competition, deterioration in the economic or industry, decline in your negative cash flows, as Matt was talking about, changes in key personnel, all things that need to be assessed. And private companies need to assess this per reporting period. So typically coming up here at the year-end audit. Either standard allows you to have a qualitative or a quantitative test. The qualitative test, similar to the trigger event, is looking at conditions surrounding the reporting unit. So these might be things like, again, changes in industry or economic environment, changes to discount rates, valuation multiples of publicly traded companies, all need to be assessed. And despite the name of the test, qualitative, there is a lot of quantitative procedures and documentation that goes into this. Some things that, like I mentioned, would be market cap of the publicly traded peer group, as well as changes in discount rates. The quantitative test, nothing has really changed here. This is, comparing a point estimate of your fair value of reporting unit to its carrying value. You're using common valuation methodologies, being the income, market, and cost approaches, and comparing that fair value to carrying value. To the extent that your fair value is less than carrying value, then you're writing down your level of goodwill between the difference of those two. What we've seen recently is a lot of companies really skipping the qualitative test and going right to the quantitative test just because of uncertainty and volatility, rather than going through the process of doing a lot of documentation on the front hand to then essentially go straight to the next step of the quantitative test. They're just going right to the quantitative test. So other considerations for the year end would be any other intangible assets that are not amortized. Things like trade names and franchise rights are often indefinite life and need to be considered. Equity awards, if you've issued new grants or have changes or modifications to an existing plan, will need to have a fair value analysis done. And then going back to earnouts, if you have a multiple year arrangement, for example, if last year you made an acquisition, there's a 3-year term to that. This year you're in year 2, you would need to fair value or mark to market that fair value of that earnout on a go-forward basis. And last, I'll mention just the ASC 360. This is kind of the little brother to the 350 test. So this is long-lived asset impairment. Again, it's a triggering event-based test, similar to the private company standard for goodwill impairments. It's a little bit of a misunderstood test because you're really looking at the lowest level of cash flows to an asset or asset group and comparing that to its fair value, to its carrying value. And it's not specifically a fair value test. So typically this is done, to give you an example of, you have a manufacturing facility that is considered to be your asset group. You would look at the expected cash flows from that asset group, that manufacturing facility, on a pre-tax undiscounted basis. So higher than, those cash flow levels will be higher than what would be used for a fair value, which would be post-tax discounted, and comparing the cash flows to the carrying value of that asset group. So it's a pretty easy hurdle to get over typically. Next, I'll turn it to Val to talk through going concern.
Thanks, Jason. So as you've mentioned, in the next couple of slides, I'll be going through a few topics that we think will be areas of focus in the upcoming audit cycle. And the first one here is the going concern analysis, which saw a ton of scrutiny last year because of the uncertainty of the long-term impacts of COVID-19. And since we're now 18 months from the start of the pandemic and the economy still hasn't fully recovered, we expect this will be an area of focus this year as well. So for your going concern analysis, management will need to put together a sensitivity analysis over the coming year and consider things like the company's forecast, any long-term contracts, any known acquisitions or disposals, and really any other activity that they think could have an impact on operations in the next year to ultimately come to a conclusion on the company's ability to continue its operations over that look-forward period. And the next point here is reference rate reform, which is in response to the upcoming retirement of LIBOR and other interbank offered rates. Last year, the SEC amended ASU 2020-04 to introduce topic 848, which supports companies that are transitioning away from LIBOR and to an alternative reference rate. And so this guidance is going to apply to any modifications that have been made between March 2020 and December 2022, and then hedging relationships either entered into or evaluated during that time. So as it relates to contract modifications, if you're modifying an agreement only to replace the reference rate and then any other changes don't have any potential impact on future cash flows, the guidance provides a handful of practical expedients to make that transition smoother. So for example, any modifications to receivable or debt agreements can be accounted for by only having to prospectively adjust your effective interest rates. And then lease modifications done within the scope of 842 can be accounted for as a continuation of the existing contract with no reassessment or remeasurement required. And then as it relates to hedging relationships, Topic 848 also allows for reference rate reform changes to not necessarily qualify as dedesignations. And so a couple of examples of these changes include certain changes in critical terms, adjustments to fair value or cash flow hedges, or changes in the method used to assess hedge effectiveness for a cash flow hedge. So really the point to make here is that the reference rate reform provides management with a lot of options on how to make the transition smoother, but the auditors are going to be looking for what changes were made and then making sure that all of the expedients that you've elected are supported by the terms of that modification. And the last area I'll mention is ASC 842 for leases. So this is a standard that's been effective for public companies for a few years now. And even though the adoption date had been pushed back for private companies, the time is finally here for most of the rest of you to adopt 842 as well, because January 1st, 2022 is the effective date for private companies with calendar year ends. And even though this isn't going to necessarily directly impact the audit, it's coming up quick and there are a few things you can do during year end to make that transition smoother. So depending on your company's structure and your lease portfolio, the lease identification process itself can be a really big undertaking. And it really isn't uncommon to see companies with multiple business segments or geographic locations managing their leases in silos, but everything's going to have to be aggregated and cataloged during that 842 implementation process. So to make this a bit easier for you next year, even starting to compile all your lease agreements pulled for this year's audit into one central location can give you a head start. And then another important thing to think about here is making sure that any service contracts or other agreements are also being reviewed to identify potential embedded leases. And another point I'll mention here for private companies is the alternative that allows them to use a risk-free rate, which is publicly available, rather than an incremental borrowing rate, which is company specific. And this makes the adoption process a lot easier for private companies because many times they don't even have the traditional inputs that are necessary to develop an IBR. And then if they wanted to use one, they might even have to get a valuation. But something to keep in mind here is that this alternative isn't available once you become a public company. So it's worth thinking about what's on the horizon for you and then agreeing with your auditor upfront on the rate you're planning on using. And then the last thing I'll mention here is considerations for companies that have already adopted 842. So over this past year and then really over the last 18 months, a lot of companies have gone through lease renegotiations to get more favorable lease terms, or they've received rent concessions. And all of these changes to your leases will need to be inventoried to make sure the supporting lease schedules are updated. And then management's going to also want to make sure all changes have been accounted for and the accounting impact's been quantified. And this is something you start thinking about now in Q4 to get ahead of that request that's inevitably going to be coming from your auditors. And then with that, I'll turn it over to Bill for the last polling question.
All right, thanks, Val. Polling question number 4. What is your biggest area of concern for this audit cycle? A, key person risk, B, audit coordination, C, going concern, D, debt versus equity, or E, income taxes? Go ahead and take a minute there to respond to those. And Val, I'm going to ask you another question, and then maybe we can hit a couple of Q&As. It looks like we got a couple of minutes. So Val, just as we think about other new standards, you talked about leases, but what other standards are out there that public companies have already adopted folks will need to think about here in the short term, especially if they're thinking about going public?
So the standard that really is top of mind for me, I would say, is CECL. So that went effective for public companies in 2020, but it's not going to be effective for private companies until 2023. But that being said, you know, like you mentioned, if you're thinking about going public, depending on your status as an EGC or not, it's going to become relevant for you in the short term. And then even if you aren't thinking about going public right now, we typically see 3 years of historical data used in that calculation. So it really wouldn't be a bad idea for everyone to start looking at their receivable data to make sure that's organized for them, so it makes the transition a bit easier.
Got it. Very good. So the current expected credit losses standard. Thanks for that. Well, why don't we hit a couple of our Q&As as we see the polling results come across here, and quite a significant number on audit coordination, which is not surprising, as well as that second one in line there, key person risk. As we mentioned, lots happening there for folks. One of the questions we have here, Jeff, this one's best for you. Question on whether you see a correlation between going concern opinions and companies recording impairments. So if a company receives a going concern opinion in their audited financial statements, is there a higher likelihood that they would also had recorded an impairment for that period.
Yeah, Bill, I mean, I think, the two are certainly related, right? But I guess I would say there's not necessarily a cause and effect relationship. I think if a company is not a going concern, if it doesn't have enough cash to operate in the next year, there's a really high likelihood probably that the goodwill is going to be impaired, right? Because the forecasted cash flows are inadequate. I think looking at it the other direction, I think if there's a goodwill impairment, it might put tension on a company's going concern. But it's important to remember that goodwill impairment is done at a reporting unit level, right? Whereas we're looking at going concern from an overall cash needs perspective. So I think looking at it the other direction, there's not necessarily a goodwill impairment, meaning that company is no longer a going concern. What I'd probably keep in mind here, Bill, is it's just important that whatever assumptions and inputs companies are using for their goodwill and their impairment assessments are probably consistent and just tie back to the same forecasts and budgets that management's using.
Yep. Good. Well, we've got time, I think, here for one more. Val, let's bring you back in. What have been some of the key challenges public companies experienced during lease adoption that the private companies should really be paying attention to as they head towards adoption?
So there's a couple of areas I think are the biggest pain points, and it's really all around the completeness of the population. So making sure you're tracking down all your leases from your components. And then if you have some long-standing leases, making sure you have the base lease and then any amendments that are also relevant during the period of adoption. And then also even considering all your service contracts, because any agreement that you have that has a specifically identified asset, like a truck or a printer or a coffee machine, can also have an impact your 842 assessment, and people don't, necessarily always think about those when they're going through this process.
Got it. That's great. All right. Well, thank you for everyone for taking some time to join us today. You enjoyed it, and we look forward to continuing to partner with you and stand ready to help with whatever business challenges you're working through. So in closing, let me just highlight for you real quick some of our recent thought leadership related to topics we discussed today. You'll find all of these and plenty more that are out there on our website. And again, we really appreciate you joining. We look forward to meeting with you again soon for a future Ask the Experts webinar. Keep your eye out for those invitations and enjoy the rest of your day.